Okay, let's unpack this. You've heard the buzz, maybe you've been swept up in the excitement, whether it was riding the wave of games or navigating the choppy waters of a downturn. We're talking about crypto.
Yeah, and as anyone who's dipped their toes in knows, alongside the tech frontier and the market volatility, there's this other layer that can feel even more complex: taxes.
Right. The world of digital assets, it innovates at breakneck speed, but the tax code, well, let's just say it takes its time.
Huh, yeah, that's putting it mildly. Yet the IRS has been remarkably consistent on one thing. Your crypto activity needs to be reported.
Absolutely. And understanding how is critical, isn't it? Not just for compliance, but because, well, smart tax planning can really impact your bottom line.
Exactly. You've given us a stack of source material, articles, guides, expert insights, and our mission today is to really cut through the noise.
We're diving deep into this seemingly daunting world of U.S. cryptocurrency taxes. How do you calculate those gains and losses? What actually counts as taxable income?
And what are the key rules, including some pretty significant changes coming down the pike that you absolutely need to be aware of?
Think of this deep dive as your shortcut to clarity. We're going to break down the fundamental concepts, walk through the calculation methods, which can drastically change your tax outcome, by the way.
Yeah, they really can. We'll explore how the dates you hold assets matter and basically arm you with the knowledge to navigate reporting everything correctly.
It's about making sense of the complexity so you can feel, confident, informed.
And potentially save some money along the way, let's face it.
Definitely. All right, let's start with the absolute foundational concept, the big picture. How is crypto treated for tax purposes in the U.S.? What's the core principle here?
Okay, the absolutely vital core concept, and this is confirmed across all the sources, is that the IRS treats cryptocurrency as property, not currency.
Property.
Yeah, this is the fundamental rule that dictates how pretty much every interaction you have with crypto is viewed. It's not like spending US dollars, it's legally more like selling, say, a share of stock or even a piece of art you own.
So when you dispose of that property, that's the trigger.
Exactly. When you dispose of that property, you trigger a potential tax event.
Property.
Yeah.
Got it. So building on that, what specific actions, what kind of transactions with this property actually trigger a tax event? When does the IRS say, okay, something taxable just happened?
Right. There are a few key triggers, and it's important to realize they're not just limited to selling for cash. The most common taxable events include, number one, selling crypto for fiat currency. This is the most straightforward one. You sell Bitcoin for US dollars on an exchange, boom, taxable event.
Simple enough.
Two, trading one cryptocurrency for another. This one catches a lot of people off guard.
Okay.
Yeah. If you swap your Bitcoin for Ethereum, or maybe Solana for Cardano, that's considered a taxable exchange of property. You've essentially sold your Bitcoin.
Even though no dollars were involved.
Exactly. You've disposed of the Bitcoin that's taxable and you've acquired Ethereum. The value of the Ethereum you received is your proceeds from the Bitcoin sale.
Okay, that's a big one. What else?
Third is using crypto to buy goods or services. If you use crypto to pay for anything, a coffee, a laptop, online subscriptions, whatever.
Like using Bitcoin to buy pizza back in the day.
Precisely. The IRS treats that as if you first sold the crypto for its US dollar fair market value at that exact moment.
Yeah, and then use those dollars to buy the thing.
You got it. The sale of the crypto is the taxable event.
So, selling for cash, trading crypto to crypto, or spending it, they're all disposals of property, all taxable events. Seems pretty comprehensive.
It covers most active transactions, yeah.
But what about just moving crypto around? Say, I send some ETH from Coinbase to my hardware wallet, like a ledger, or maybe from one software wallet to another one I control. Is that taxed?
That is a absolutely crucial distinction, and thankfully much simpler. Moving crypto between wallets or accounts that you own and control does not trigger a taxable event.
Okay, that's good to know.
Yeah, because you haven't changed ownership. You've just moved your property from, say, your digital pocket to your digital safe deposit box.
Like moving money between my checking and savings accounts.
Exactly like that. No tax is incurred on the transfer itself. But, and this is important, keeping meticulous records of these transfers is vital.
Why is that?
Because they impact the cost basis tracking within those specific wallets, especially with the new rules coming up, which we'll definitely get into later. Record keeping is key even for non-taxable moves.
Right, makes sense. It's about ownership changing or getting something in return, not just relocation. Now, the sources mentioned two main categories of crypto tax we need to think about.
Correct. Based on these events, you'll primarily encounter two types of tax implications. First, you have capital gains or losses. These arise from those disposal events we just talked about, selling for fiat, trading crypto for crypto, or spending crypto. When you sell or exchange property, you realize a capital gain if what you get back, the proceeds, is more than what it originally cost you, your cost basis.
And a capital loss if it's less.
Precisely. The second type is ordinary income.
Ordinary income, how does that work with crypto?
This is crypto you receive without necessarily selling something you already owned first. Think about things like rewards from staking your crypto, income from mining crypto you get in airdrops,
Yes.
interest you earn from lending crypto or through DeFi protocols, referral rewards paid out in crypto, or even just getting paid for work or services in crypto.
So if a client pays me in Bitcoin,
Yep, that's ordinary income. This type of income is taxed based on the US dollar fair market value, the FMV of the crypto at the exact date and time you received it.
wow, okay. So if I get an airdrop, or like you said, get paid for freelance work in Bitcoin, the value of that Bitcoin, the moment it hits my wallet, is considered ordinary income. And that's the value I pay income tax on.
Precisely. That FMV at the moment of receipt is your ordinary income for the year. And this is also really important. That same FMV also becomes your cost basis for that specific bit of crypto going forward.
Ah, okay. So if the price goes up after I receive it, and then I sell it later.
Any gain above that initial FMV, which is now your cost basis, is then a capital gain.
And if the price goes down and I sell for less.
Then you'd have a capital loss relative to that initial cost basis you established when you first received it.
So receiving crypto as income is actually like a two-step thing for taxes. You've got ordinary income when you get it,
Right.
and then potentially a capital gain or loss later on when you sell, trade, or spend it.
That's absolutely right. And that's exactly why tracking the date, time, type, amount, and FMV of every single transaction, disposals, income receipts, everything is so foundational to getting crypto taxes right.
It sounds like a lot of tracking.
It can be, especially for active users.
Okay, got it. Now let's get into the calculation itself. Let's say we've had a taxable disposal event, a sale, a trade, or we spent some crypto. How do we figure out the capital gain or loss? What's the core formula?
The core formula, and it sounds simple on the surface, is capital gain loss, proceeds cost basis.
Proceeds minus cost basis.
Okay, this applies whether you sold for dollars, traded for other crypto, or used it to buy something.
Let's break down those two terms then. What exactly are proceeds?
Proceeds are basically what you received in exchange for the crypto you got rid of. If you sold for US dollars, the proceeds are simply the total cash amount you received.
Straightforward.
If you traded crypto for another crypto or used crypto to buy goods or services, the proceeds are the fair market value, in US dollars, of whatever you received the other crypto, the goods, the service, at the precise moment of that transaction.
And what about fees? Like exchange fees?
Yeah. Good point. It's important to subtract any transaction fees you paid, like trading fees on an exchange, directly from your proceeds. This reduces your net gain or increases your net loss.
Okay, so proceeds is what you got, minus selling fees. Now, cost basis.
Your cost basis is your original cost to acquire the specific units of crypto you just disposed of.
How do you figure that out?
Well, if you bought the crypto with fiat currency, your cost basis is typically the amount of fiat you paid, plus any fees you paid to acquire it, like deposit fees or the exchange's purchase fee.
Okay, purchase price plus acquisition fees.
Right. And if you receive the crypto as income, remember, from mining, staking, airdrops, getting paid, your cost basis is that fair market value in US dollars we talked about at the exact date and time you received it.
Got it. So the income value becomes the basis for later calculations.
Exactly.
Okay, let's use that simple example from the sources to see this formula in action. Mitchell buys 1 ETH for $2,500. A month later, he sells that exact 1 ETH for $3,500.
Okay, in that nice, clean scenario, proceeds are $3,500 the cash he got. Cost basis is $2,500 his original purchase price. So the capital gain equals $3,500 minus $2,500, which equals $1,000 gain.
Simple enough when it's just one buy and one sell of the exact same thing.
Yeah, that one's clear. But as the sources immediately point out, real life is rarely that simple.
Right. Most crypto users don't have just one buy and one sell. They're buying the same crypto, say Bitcoin, multiple times at totally different prices on different dates, maybe across different exchanges.
And then they sell or trade just some of their holdings, not everything.
Exactly. And this is where figuring out the cost basis for the specific units you sold becomes the real challenge.
Absolutely. This is the crux of it. Imagine you bought Bitcoin 5 different times over 2 years. Maybe once at $10,000, then $60,000, then back down at $30,000. You get the idea. Now you decide to sell just one Bitcoin. Which one did you sell? The $10K one, the $60K one, the $30K one.
Your answer to that question changes the calculation completely.
It changes everything. The answer, determined by your accounting method, directly impacts your cost basis for that specific sale, and therefore your gain or loss, and ultimately how much tax you owe. This is arguably the most critical concept in crypto tax calculation.
And this brings us to that crucial concept, cost basis methods. This is how you figure out which batch of crypto you're selling when you dispose of only part of your stack.
Exactly. These methods provide a systematic way to match the crypto units you sell with their original purchase price or value their cost basis. The IRS allows several methods, and your choice can have a huge impact on your tax bill, especially when prices are bouncing around.
What are the main methods we need to know?
The main ones are FIFO, first in, first out, LIFO, last in, first out, HIFO, highest in, first out, and the broader concept of specific identification.
Okay, let's walk through each of those. Maybe use a slightly more involved example than Mitchell's single ETH. Let's use the other ETH example from the sources. First, you buy one ETH for $2,250 on date A. Later, you buy another one ETH for $2,500 on date B. And then you sell one ETH for $3,000 on date C.
Perfect. Let's start with FIFO, first in, first out.
The common one, right, off to the default.
Yeah, it's very common and often considered the IRS's preferred or default method if you don't clearly use and document another one. FIFO means you assume that the very first coins you acquired, chronologically, are the first ones you sell. You're selling your oldest inventory first.
So in our ETH example, bought the first for $2,250, the second for $2,500. When you sell one ETH for $3,000 using FIFO, which one goes?
You're considered to have sold the ETH that you acquired first. That's the one with the $2,250 cost basis.
Okay.
So proceeds equals $3,000. Cost basis, FIFO, equals $2,250. Capital gain equals $3,000 minus $2,250. That's a $750 gain.
Got it. What are the pros and cons of using FIFO? Why is it often the default?
Well, FIFO is pretty straightforward conceptually and often easier to track if your records are decent. It's less susceptible to being seen as, manipulating things purely for tax reasons compared to methods where you pick specific lots.
Makes sense.
In periods of falling prices, sometimes selling your oldest coins first might mean selling higher cost basis coins, which could help realize losses sooner. But maybe more importantly, because you're always selling your oldest coins first, FIFO naturally helps your remaining holdings age faster towards qualifying for the lower long-term capital gains tax rates.
Because the ones left are the newer ones, but the ones you sold were held longest.
Exactly. The main disadvantage is that in a generally rising market, FIFO often results in the largest capital gain compared to other methods because you're selling your oldest, cheapest coins first.
Right, like in our example, selling the $2,250 coin resulted in a $750 gain.
Okay.
Next up is LIFO, last in, first out.
With LIFO, you assume the most recent coins you acquired are the first ones you sell. You're selling your newest inventory first.
Using our same ETH example, buy its $2,250s, then $2,500, then sell one ETH at $3,000 under LIFO.
You're considered to have sold the ETH you acquired last. That's the one with the $2,500 cost basis.
Okay.
So proceeds equals $3,000. Cost basis, all LIFO, equals $2,500. Capital gain equals $3,000 minus $2,500. That's a $500 gain.
So in this simple example, LIFO gives a $500 gain compared to the $750 gain with FIFO. That's a $250 difference in taxable gain just from choosing a different accounting method.
Exactly. It perfectly illustrates the power of the method choice. LIFO can be advantageous tax-wise in periods of generally rising prices.
Why is that?
Because you're selling the newer coins, which likely have a higher cost basis if prices have been going up. A higher cost basis means a smaller potential capital gain.
Makes sense. What's the downside?
The disadvantage is that your oldest coins, the ones that might have a really low cost basis from way back when, stay in your inventory longer. If you eventually sell those, you could face larger gains down the line.
And it doesn't prioritize selling the longest held coins, so maybe less helpful for hitting that long-term gain threshold quickly.
Right. Compared to FIFO, it's less likely to automatically result in long-term gains unless you specifically hold those newer coins you're selling for over a year.
Okay. Now let's look at HIFO, highest in, first out. This one sounds like it's explicitly designed for tax minimization.
That's precisely the goal of HIFO. It assumes you sell the coins with the highest cost basis first, regardless of when you actually bought them. You're prioritizing getting rid of the most expensive coins from a tax perspective
Why did you do that?
to minimize your current gain or maximize your current loss.
Okay, going back to our ETH example, buy at $2,250, then $2,500, sell at $3,000. The highest cost basis between those two coins is the $2,500 one, so under HIFO.
Just like with LIFO in this specific example, because the last one bought was also the highest cost, you'd be considered to have sold the coin with the $2,500 cost basis.
So the math is the same here. Proceeds $3,000, cost basis HIFO, $2,500, gain $500.
Right. But ITRIFO really shows its potential impact in more complex scenarios with more purchases at very different prices.
Yeah, the sources have that much more dramatic Bitcoin example that really hammers this home. Let's walk through that. 3 purchases. 1 BTC at $8,000, another 1 BTC later at $50,000, and a third 1 BTC even later at $19,000. Then you sell just 1 BTC for $23,000. Let's run the numbers for each method.
Okay, this is where the difference becomes crystal clear. Under FIFO, first in, first out, you sell the oldest coin, the one bought at $8,000. Gain equals $23,000 proceeds minus $8,000 cost basis, equals a $15,000 capital gain.
$15,000 gain.
Now, under LIFO, last in, first out, you sell the newest coin, the one bought at $19,000. Gain equals $23,000. Proceeds minus $19,000 cost basis. That's the one bought way up at $50,000.
Okay.
It could be significantly less gain than FIFO.
Right. Now, under HIFO, highest in, first out, you sell the coin with the highest cost basis. That's the one bought way up at $50,000. Loss equals $23,000. Proceeds minus $50,000 cost basis equals a $27,000 capital loss. Wow. Okay, stop right there. On the exact same sale of 1 Bitcoin for $23,000, you could have a $15,000 taxable gain with FIFO, a $4,000 gain with LIFO, or a $27,000 deductible loss with HIFO.
That's the power and the complexity of choosing your accounting method. It's a perfect illustration of HIFO as a tax minimization strategy in action.
Because realizing that loss is valuable.
Incredibly valuable for tax purposes. Capital losses can offset any amount of capital gains you have in the same year. Dollar for dollar.
So if I had other gains, say from stocks or other crypto sales, that $27,000 loss could wipe them out.
It could wipe out up to $27,000 of other capital gains. And if your losses exceed your gains for the year, you can use up to $3,000 of that net capital loss to offset your ordinary income, like your salary or business income.
Reduce your regular taxable income by $3,000.
Nice. And if you have even more net loss left over after offsetting gains and that $3,000 of ordinary income,
what happens then?
The remaining net capital loss can be carried forward indefinitely to offset capital gains and up to $3,000 of ordinary income in future tax years.
Wow, okay, so losses aren't just lost money, they're a potential future tax asset. This is key for tax loss harvesting, right?
Absolutely. HIFO is often the core method used in tax loss harvesting strategies, especially in volatile crypto markets, where you might have some positions significantly underwater while others are in profit.
Makes sense. Now, you also mentioned specific identification. How does that fit in?
Right. Specific identification is kind of the overarching principle. It means you are specifically identifying which exact units of crypto you are selling from your inventory.
So instead of just relying on a rule like FIFO or LIFO,
you're saying, I am selling this specific Bitcoin that I bought on this date for this price. LIFO and HIFO are actually considered variations or types of specific ID methods because you are intentionally selecting units based on a specific rule, last in or highest cost.
Does the IRS allow this? Can I just pick whichever coin gives me the best tax result?
The IRS does allow specific identification, and yes, it offers the most flexibility because, in theory, you can pick any specific units you own to sell. This could allow you to strategically target, say, a specific long-term gain or a specific loss, or maybe just the absolute minimum possible gain for that transaction.
But there's always a catch, isn't there? What's the caveat with specific ID?
There is, and it's a big one. Record keeping. To use specific identification, you must maintain exceptionally detailed and contemporaneous records. The IRS requires you to be able to clearly prove the date and time you acquired each specific unit, your cost basis for each specific unit, the date and time you sold those specific units.
Okay, seems doable with good tracking.
And this is the toughest part, documentation proving your intent to sell those specific units at the time of the sale. This often means needing records from your exchange or wallet that explicitly link the disposition back to the specific acquisition lot you chose.
That sounds hard to prove definitively.
It can be very difficult. If your records aren't meticulous enough to satisfy the IRS that you legitimately identified and tracked the specific units sold, they have the authority to disregard your chosen method
And force you back to what?
and force you back to using FIFO,
Mhm.
which, as we saw in that Bitcoin example, could result in a much higher tax bill than you anticipated if you were aiming for a LIFO or a HIFO result.
So, specific ID offers flexibility, but requires intense record-keeping discipline. And the sources also mentioned something about switching methods year to year. You can do that, but be careful.
Yes, you are generally allowed to change your inventory accounting method, say, from FIFO one year to HIFO the next. However, it adds another layer of complexity.
How so?
You need to be extremely careful in the year you switch to correctly account for the cost basis of the inventory that's carried over from the previous year under the old method. It's easy to make calculation errors when switching, especially if you have a lot of transactions.
And errors could mean.
Errors could lead to underreporting your tax liability, which could unfortunately result in penalties and interest if you get audited. That's why the sources strongly recommend consulting a tax professional before switching methods, especially with complex trading histories.
Okay, this is already getting quite complex, just figuring out which coins you sold and their basis. And now it sounds like the rules themselves are evolving, getting even more granular. The sources highlight big changes coming for 2025, specifically about tracking across different wallets or exchanges.
They do, and this is a major shift in crypto tax reporting. It's moving away from what's been informally called the universal tracking method to a mandatory per wallet or per account
How
method.
does that start?
This new rule is required for transactions occurring on or after January 1st, 2025.
Okay, so starting with the 2025 tax year, let's first understand what the old way universal tracking meant. How did that work before 2025?
Under universal tracking, which was generally accepted practice, you could essentially treat all your holdings of a specific crypto, say all your Bitcoin, as one big pool, no matter if it was spread across Coinbase, Kraken, a Ledger wallet, MetaMask, etc.
One giant pot of Bitcoin.
Right. And when you sold some BTC from, say, your Coinbase account, you could apply your chosen cost basis method, FIFO, LIFO, HIFO, to your entire pool of BTC holdings across all your accounts to determine the cost basis.
Let's use Caleb's example from the source to make this concrete. He buys one BTC for $20,000 on exchange A. Later, he buys another one BTC for $25,000 on exchange B. Then he sells one BTC from exchange B under the old universal tracking rule using FIFO. What's his basis?
He'd look at his entire BTC pool. The earliest BTC he acquired was the $20,000 one on exchange A. So even though the sale happened on exchange B, his cost basis under universal FIFO would be $20,000.
So he sold for, say, $23,000.
His gain would be $23,000 minus $20,000, which is a $3,000 gain.
Okay, that's the old way. Now, the new rule, the per wallet per account method, required from January 1st, 2025. How does that change Caleb's situation when he sells that one BTC from exchange B?
This fundamentally changes the calculation. Under the per wallet rule, when you dispose of crypto from a specific wallet or account, you must match that sale with crypto acquired within that same specific wallet or account.
You can only look at the history of that wallet.
Exactly. You apply your chosen cost basis method, FIFO, LIFO, HIFO, only to the inventory of that crypto within that specific wallet or account where the sale occurred.
So when Caleb sells one BTC from exchange B under the new rule, he has to look only at the BTC he bought on exchange B.
Correct. And his only purchase on exchange B was the one BTC for $25,000.
So that becomes his cost basis.
Yes, his cost basis for that sale must be $25,000, regardless of the cheaper BTC sitting over on exchange A.
So if he sells that BTC from exchange B for the same $23,000,
Now the calculation is, proceeds $23,000 minus cost basis per wallet, $25,000, which results in a negative $2,000 loss, a capital loss.
whoa. Okay, that is a $5,000 swing in the tax outcome on the exact same sale just because of this rule change. From a $3,000 gain under the old method to a $2,000 loss under the new per wallet rule in this specific case.
It truly highlights the impact. The change mandates a much more granular level of record keeping. You can't just pool everything anymore.
What's the thinking behind this change?
It prevents users from easily, let's say, cherry-picking cost basis across different accounts to get the best short-term tax result. Selling from an account but claiming the basis from a purchase in a totally different account. Now, the sale from exchange B must use the basis from buys on Exchange B.
Your chosen method, CFO, LIFO, HIFO, still applies, but only within that wallet's inventory.
Correct. The method applies, but only to specific inventory within that account or wallet.
What about transfers between my own wallets? Still non-taxable.
Yes. Transfers between your own wallets are still non-taxable events. However, the cost basis information moves with the asset. When you transfer BTC from Exchange A to Exchange B, its original cost basis and acquisition date travel with it and become part of Exchange B's inventory for future calculations under the per wallet method.
Okay, so tracking transfers accurately becomes even more critical now.
Absolutely. It adds complexity, no doubt about it.
And layered on top of this new per wallet rule, there's another major change coming soon regarding how exchanges report to the IRS, right? Starting in 2026 for the 2025 tax year.
Yes, this is arguably the biggest compliance shift we've seen in the space. Starting in 2026, crypto exchanges and brokers operating in the U.S. will be required to issue a new form, Form 1099-DA, to both their users and the IRS.
1099-DA, what's that comparable to?
It's directly analogous to the Form 1099-B that stockbrokers have issued for years. It's a game changer for crypto reporting.
What information will be on this 1099-DA?
It will report key details about your crypto transactions directly to the IRS, including gross proceeds from your sales, trades, and other dispositions, the cost basis of the assets you sold importantly, calculated by the exchange according to mandated rules, which will likely include the per wallet requirement.
Wow, they'll calculate the basis.
Yes, based on specific rules they'll have to follow. It will also state whether the gain or loss is short-term or long-term based on the holding period and the dates of acquisition and disposition for the assets sold.
This means the IRS is going to have a much, much clearer picture of individual crypto activity than they ever have before.
Exactly. Relying on transactions somehow slipping under the radar or reporting numbers significantly different from what the exchange calculates is going to become much riskier.
It definitely increases the importance of accurate reporting and understanding how the exchanges themselves might be calculating things. Probably raises the likelihood of audits if your numbers don't match theirs.
It certainly seems likely. Consistency between what you report and what the 1099-DA shows will be crucial.
Absolutely. Okay, so with all these calculations, figuring out gains, losses, applying cost basis methods, understanding the new per wallet rule, what are the actual steps for getting this information onto your tax return? The sources laid out about 5 steps.
Right. Let's boil it down to the practical filing steps. Step 1. Calculate your gains and losses and determine your ordinary crypto income. We've spent a lot of time on the calculation methods and income types. The critical first part of this step is gathering all your transaction records.
From every single place you interact with crypto, right? Exchanges, DeFi, wallets where you get rewards.
Every single one. And this is often the most time-consuming and, frankly, difficult part for individuals, especially if you've been active for a while across multiple platforms.
And as we've seen, doing this manually for more than a few transactions is incredibly complex and just ripe for errors.
Precisely, which is why, as we'll discuss later, software or professional help becomes almost essential for many people.
Okay, assuming you had the calculations done, what's step 2?
Step 2. Report your capital gains and losses on Form 8949, Sales and Other Dispositions of Capital Assets.
Form 8949, what specifically goes on there?
Form 8949 is basically the detailed ledger. You list each individual disposal event. So every single time you sold crypto for fiat, traded crypto to crypto, or spent crypto to buy something, that's an entry on this form.
What info for each one?
For each transaction, you need a description of the asset, like 0.5 ETH. The date you acquired it, the date you sold or disposed of it, your proceeds from the sale, your cost basis for those specific units using your chosen method, FIFO, LIFO, ITOFO, etc., and the resulting capital gain or loss.
Okay, and I remember seeing it split into parts.
Yes, Form 8949 is divided into Part 1 for short-term transactions, where you held the asset for 12 months or less, and Part 2 for long-term transactions held more than 12 months.
And there's some boxes to check too, A, B, C.
Right. Those boxes indicate how the transaction was reported to you. Box A is typically for transactions reported on a 1099-B showing basis reported to the IRS. Box B is for 1099-B showing proceeds only. Box C is for transactions not reported on a 1099-B.
And currently, most crypto falls under C.
Currently, yes, Box C is most common for crypto. But with the introduction of Form 1099-DA starting in 2026 for the 2025 tax year, we expect many more transactions reported by exchanges will start falling under the other boxes, likely Box A, as basis reporting becomes mandatory for them.
Okay, so 8949 is the detailed list of every sale, trade, and spend. What's step 3?
Step 3. You take the totals from Form 8949 and include them on Schedule D capital gains and losses.
Schedule D, what does that do?
Schedule D acts as the summary form for all your capital gains and losses. It takes the subtotals from Part 1 short-term and Part 2 long-term of all your Form 8949s.
It combines them with any other capital gains or losses, maybe from stocks or mutual funds.
Exactly. It aggregates everything to arrive at your overall net capital gain or loss for the entire year.
So 8949 provides the details. Schedule D gives the final capital gain loss number that goes onto your main tax return.
Correct. Then, step 4, you need to include your other crypto income, the ordinary income part, on either Schedule 1 or Schedule C.
Right, that income from staking, mining, airdrops, interest, getting paid. Where does that go specifically?
It depends on whether the activity is considered a hobby or a business. If it's more like a hobby or just occasional income like small staking rewards or an airdrop, you'll typically report it on Schedule 1, Form 1040, additional income and adjustments to income. There's usually a line for other income.
And if it's more serious, like a business?
If your crypto activity constitutes a trade or business, for example, you're running a professional mining operation with significant investment and intent to profit, or you regularly get paid in crypto for your business services, then you'd report that income and also deduct relevant business expenses on Schedule C, profit or loss from business.
And the amount reported, is that fair market value at the time of receipt?
Yes, always the FMV when you received it for ordinary income.
Got it. And step 5 is just finish your taxes.
Essentially, yes. Step 5. Complete the rest of your tax return, Form 1040, incorporating the net capital gain or loss figure from Schedule D and any ordinary crypto income reported on Schedule 1 or Schedule C.
Okay, that clarifies the forms. Now, this brings us back to a really critical point we touched on, the tax rates. We keep mentioning short-term versus long-term. What are the actual tax rate implications of that holding period? This seems huge.
It is huge. This is where the holding period becomes incredibly important for potentially lowering your tax bill on capital gains. Your tax rate depends entirely on whether you held the asset for 1 year or less or for more than 1 year.
So what's the rate for short-term?
Short-term capital gains from assets held 12 months or less are taxed at your ordinary income tax rate.
The same rate as my salary or wages?
Exactly. It's the same rate you pay on your job income or that ordinary crypto income from staking or mining we just discussed. These ordinary income tax rates are progressive, meaning they increase as your income goes up. For 2024, they range from 10% up to 37%, depending on your overall taxable income bracket.
Okay, so short-term gains just get added to your regular income and taxed at those potentially high rates. Now, what about long-term?
Long-term capital gains from assets held for more than 12 months get special treatment. They're taxed at significantly lower preferential rates.
Or how?
These long-term rates are typically 0%, 15%, or 20%, depending on your total taxable income and filing status.
0%, really?
Yes. For example, in 2024, the 0% long-term capital gains rate applies if your total taxable income is below certain thresholds, around $47,000 for single filers or $94,000 for married couples filing jointly.
Wow. And above that?
The 15% rate covers a very broad middle range of incomes up to about $518,900 for single filers or $585,000 for married filing jointly in 2024. Only above those high thresholds does the 20% rate kick in.
So just by holding a crypto asset for 1 year and 1 day, instead of 1 year or less, you could potentially cut your tax rate on the profit from, say, 22% or 24% or even higher, down to 15% or maybe even 0%.
Exactly. It's a massive potential tax saving, especially if you have significant gains. The Investopedia example in the sources make this very clear.
Remind me of that one.
It was a married couple earning $100,000 with the $3,000 crypto gain. If it was short-term, it's taxed at their ordinary rate, which was 22% in the example, meaning $660 in tax.
Okay.
But if they held it for over a year, making it long-term, it falls into the 15% long-term rate bracket for their income level. The tax is only $450.
That's a $210 saving on just a $3,000 gain.
Right. And if you scale that up for larger portfolios or bigger gains, you can see how strategically timing your sales to qualify for long-term treatment becomes incredibly important for tax efficiency.
Definitely. Now, a clarifying question.
Mm-hmm.
If I have a large long-term capital gain, does that gain itself push my ordinary income, like my salary, into a higher tax bracket?
No, and that's a really important distinction. Long-term capital gains are taxed using their own separate rate structure, 0%, 15%, 20%. While the amount of your long-term gain does factor into determining which of those brackets applies to the gain itself, the gain amount does not get added back to your ordinary income for calculating your ordinary income tax.
So it won't bump my salary into the next higher ordinary income bracket.
Correct. Long-term gains don't affect your ordinary income tax bracket. However, remember that short-term capital gains are added directly to your ordinary income. So a large short-term gain could potentially push some of your ordinary income into a higher tax bracket.
Okay, that distinction between how short-term and long-term gains interact with ordinary income brackets is really key. Good to clarify. Beyond just calculating gains, the sources talk a lot about leveraging losses and some other interesting nuances, including something unique about the wash sale rule for crypto.
Yes, tax loss harvesting. This is a fundamental strategy for managing your overall tax liability, and it's especially relevant in volatile markets like crypto, where you likely have some positions down while others are up.
How does it work again?
As we discussed briefly, capital losses can offset capital gains. If you sell some assets at a loss and others at a gain within the same tax year, the losses directly reduce the amount of gain that's subject to tax.
Like James's simple example. $1,000 gain, $1,000 loss.
Yep.
Net result is zero taxable gain.
Exactly. The $1,000 loss cancels out the $1,000 gain. And if your total capital losses for the year are more than your total capital gains,
That's when the $3,000 rule comes in.
right, you can use up to $3,000 of that net capital loss to reduce your ordinary income for the year. Any remaining net loss beyond that $3,000 can be carried forward indefinitely to offset future capital gains and income. Tax losses are valuable.
Definitely something to manage actively. Now, the wash sale rule, people who invest in stocks know this rule well, but the sources say it's different for crypto.
Correct. The standard wash sale rule, found in Section 1091 of the tax code, is designed to stop investors from gaming the system with stocks and securities.
How does it stop them?
It says you cannot claim a tax loss on the sale of a stock or security if you buy back a substantially identical stock or security within 30 days before or 30 days after the sale where you realize the loss. Basically, you can't sell for a loss on Monday and buy it right back on Tuesday just to get the tax deduction while staying invested.
Okay, that makes sense for stocks. But for crypto?
Crucially, under current IRS guidance and tax law, this wash sale rule does not apply to cryptocurrency.
Why not?
Because, as we established right at the beginning, crypto is classified as property, not a security like stocks or bonds, for the purposes of this specific rule, Section 1091.
Wait, so this means if I sell my Bitcoin today at a loss to capture that loss for tax loss harvesting, I can immediately buy the exact same amount of Bitcoin back, maybe minutes later, and still claim that capital loss on my taxes.
That is correct. Under current rules, you can. This is a significant difference and a powerful tax planning opportunity unique to crypto compared to traditional securities.
So you can harvest the loss without having to stay out of the market for 30 days and risk missing a potential rebound.
Exactly. You can realize the tax benefit of the loss while immediately reestablishing your position. It needs careful execution and, of course, meticulous record keeping, but it's a legitimate and widely used strategy in the crypto space right now.
That is a major, major difference people need to be aware of. Wow. Okay, what about reporting thresholds? There's this persistent idea, you hear it sometimes, that you only need to report crypto if you have over, say, $600 in activity or income. Is there any truth to that?
This is a really dangerous misconception. It likely stems from the fact that some platforms might issue a Form 1099 MISC or 1099 NEC if they pay you $600 or more in income, like staking rewards, referral bonuses, etc.
But that's just for income reporting from the platform side.
Right. The legal requirement for you, the taxpayer, is crystal clear. You must report all taxable income from all sources and all capital gains and losses from property sales, regardless of the amount.
So even a tiny gain is reportable?
Yes. Selling crypto for a $5 gain is technically just as reportable as selling it for a $50,000 gain. Receiving $2 in staking rewards is reportable ordinary income, just like receiving $2,000. There is no de minimis amount below which reporting is excused for capital gains or income.
So not reporting any taxable gain or income, even if it's small, is technically.
Technically, it's tax noncompliance, potentially tax fraud. And with the upcoming Form 1099 DA reporting from exchanges, the IRS is going to have visibility into many of these transactions anyway, even small ones. The $600 threshold is largely irrelevant for your personal reporting duty on gains and income.
Good to bust that myth. And related to reporting, there's that prominent question right near the top of the main Form 1040 tax return these days, asking about digital assets.
Yes, that question has been there for a few years now. It asks basically if at any time during the tax year you did certain things with digital assets.
What kinds of things?
It asks if you A, received any digital asset as a reward, award payment, etc., or B, sold, exchanged, gifted, or otherwise disposed of a digital asset or a financial interest in one.
So pretty much any interaction beyond just buying and holding it passively in your own wallet likely means you should check yes.
Generally, yes. If you sold, traded, spent, received staking rewards, got an airdrop, were paid in crypto, you likely need to check yes.
Does checking yes automatically increase your risk of getting audited? People worry about that.
According to the sources and most tax professionals, simply checking yes to this question is primarily for the IRS's information gathering. It doesn't in itself automatically increase your tax liability or flag you for an audit. But deliberately checking no when you should have checked yes is considered making a false statement under penalty of perjury, which is tax fraud. The real key is consistency. If you check yes, then the rest of your return, specifically Forms 8949, Schedule D, Schedule 1C, needs to accurately reflect the crypto activity that necessitated checking yes.
And again, with 1099 DA coming, the IRS will have data to cross-reference anyway.
Precisely. Hiding activity is becoming increasingly difficult and risky.
Okay, let's shift focus slightly to NFTs, non-fungible tokens. These are also digital assets, but they're unique, not interchangeable like Bitcoin. The sources suggest they add even more layers of tax complexity.
They absolutely do. NFTs, because they are unique digital assets also treated as property, follow many of the same tax principles as cryptocurrencies, but with some potentially significant twists and uncertainties.
Let's start with someone who creates and sells an NFT, like an artist.
Right. If you are the creator, the artist, musician, developer who mints and then sells an NFT, you created the income you receive from that initial sale, and any subsequent royalties you might get is generally treated as ordinary income.
Like income from selling any other artwork or creative work.
Exactly. And because it's income, it could also be subject to self-employment tax, Social Security, and Medicare if your NFT creation and sales activity rises to the level of a trade or business.
Can you deduct expenses related to creating it?
Yes, like any business or artistic endeavor, you can typically deduct relevant expenses against that income. Things like gas fees paid for minting, software costs, marketing, platform fees, maybe even art supplies if applicable.
Okay, that's for the creator.
Sure.
What about someone who buys an NFT, maybe as an investment?
Well, first, how you buy it matters. If you use cryptocurrency, say Ether, to purchase an NFT,
Uh-oh, I sense a taxable event coming.
you got it. Using appreciated crypto to buy an NFT triggers a taxable event on the crypto you used. It's treated as if you sold the Ether for its fair market value at that moment.
So the proceeds are the value of the NFT you received.
Correct. The proceeds from your sale of Ether are the fair market value in USD of the NFT at the time of the transaction. You calculate your capital gain or loss on the Ether based on its cost basis versus that FMV.
Wow. Okay, so just buying an NFT with crypto that has gone up in value can create a tax bill right then and there on the crypto part.
Yep. Now, what about selling the NFT itself later?
Right, if I hold it as an investment and then sell the NFT.
When you sell an NFT that you held as an investment, a capital asset, that sale is subject to capital gains tax, just like selling stock or crypto.
Calculation is the same. Proceeds minus basis.
Yep, gain or loss. Proceeds received from selling the NFT minus your cost basis in the NFT. Your cost basis is generally what you paid for it, the FMV of the crypto or fiat used, plus any acquisition fees like gas fees.
In short-term versus long-term rules apply based on how long you held the NFT.
Exactly. Held 12 months or less, it's a short-term gain loss taxed at ordinary rates. Held more than 12 months, it's a long-term gain loss. However,
Here comes the twist.
here comes the potentially big twist, the collectibles issue.
Collectibles. Like baseball cards or fine art.
Potentially, yes. There's a significant point of uncertainty in the current tax landscape regarding whether the IRS might classify NFTs as collectibles for tax purposes.
Why does that matter?
It matters because long-term capital gains on assets classified as collectibles are subject to a special higher maximum tax rate up to 28%.
28%. That's higher than the usual max long-term rate of 20%.
Correct. So if your NFT investment is deemed a collectible, your long-term gain could be taxed at a significantly higher rate than a similar long-term gain on Bitcoin or Ethereum.
Is this decided yet? Do we know if NFTs are collectibles?
No, that's the problem. It's still a gray area. The IRS hasn't issued clear, definitive guidance specifying whether all NFTs, or perhaps only certain types of NFTs, like digital art versus, say, an NFT representing virtual land, fall under this classification.
So it's a risk factor to be aware of for NFT investors.
Absolutely. The potential for this higher 28% tax rate means careful consideration and maybe professional advice is really warranted for significant NFT gains, especially long-term ones.
Okay, let's recap the NFT complexity then. If you create and sell, that's ordinary income plus maybe self-employment tax. If you buy with appreciated crypto, that triggers a gain loss on the crypto. If you sell the NFT, that's a capital gain loss, short or long term.
And that long-term gain might be taxed at a higher 28% rate if it's considered a collectible.
Wow, that is definitely multiple layers of potential tax hits and complexity to track.
It absolutely is. It really underscores the layered nature of digital asset taxation and hammers home the need for meticulous record keeping for every single step involving NFTs, minting, buying, selling, everything.
We've been focused mainly on U.S. federal taxes. What about state taxes? Do they follow the same rules for crypto gains?
State tax treatment adds yet another layer of variability. First, not all states even have a state income tax or a capital gains tax.
Like Florida or Texas?
Right. States like Alaska, Florida, Nevada, New Hampshire, which only taxes interest dividends, South Dakota, Tennessee, Texas, Washington, and Wyoming don't have a broad-based state income tax, so they generally won't tax your crypto capital gains at the state level.
What about Washington State? Didn't they add something?
Good point. Washington is unique. They don't have an income tax, but they recently implemented a separate 7% tax specifically on long-term capital gains exceeding a high threshold, around $250,000 per year. So high-value, long-term crypto gains could be taxed there.
Okay, so some states have no tax. What about the ones that do have income tax?
For states that do have an income tax, they generally start by conforming to the federal rules for calculating capital gains, like using your federal adjusted gross income as a starting point. However, the tax rates can vary significantly from state to state, and some states have their own specific rules, deductions, or credits related to capital gains.
Any examples?
The sources mentioned a few. Colorado apparently has an exclusion for gains from certain types of property held over a year. New Mexico allows a deduction against state tax for a portion of federally taxed long-term capital gains. Montana offers a tax credit related to certain capital gains.
So the bottom line is you really need to check your specific state's tax laws.
Absolutely. You can't assume federal rules apply identically at the state level. You need to understand your own state's income and capital gains tax system.
Okay. This sounds, well, incredibly complex, especially for anyone who's actively trading, involved in DeFi, maybe minting or trading NFTs, using multiple exchanges and wallets, gathering all those records, applying the right cost basis method consistently, remembering the per wallet rule, tracking income versus gains. Is there any way to simplify this whole process? It feels overwhelming.
Thankfully, yes. Trying to manage all the record keeping and complex calculations manually for anything more than just a handful of very basic transactions is, well, it's often overwhelmingly difficult and extremely prone to errors.
I can imagine.
This is exactly where crypto tax software has become an absolutely essential tool for a huge number of crypto users.
How does that software actually help in practice? What does it do?
Good crypto tax software is specifically designed to automate most of the heavy lifting involved in these calculations.
Like connecting to exchanges.
Exactly. You can usually connect your various exchange accounts using APIs, or you can upload CSV files of your complete transaction history. You can also often import data directly from various blockchain addresses or wallets.
So it pulls all the raw data together.
Yes, it aggregates all your buys, sells, trades, deposits that might be income, like staking rewards, withdrawals, and transfers from all these different sources into one place.
What does it do with the data then?
The software can then automatically identify and handle internal transfers between your own wallets, recognizing they aren't taxable events, but correctly moving the cost basis information. It can often identify income events like staking or airdrops based on transaction patterns or labels.
And calculate the FMV for income.
Yes, it typically pulls historical price data to calculate the US dollar FMV at the precise time you received that income, which establishes both the income amount and the cost basis. It then tracks the cost basis for all the assets you acquire.
And when you sell?
When you sell or dispose of assets, the software applies your chosen accounting method, FIFO, LIFO, HIFI, across your inventory. And importantly, for transactions in 2025 and beyond, Good software will be updated to correctly apply the new per wallet rule when calculating gains and losses.
So it does the complex matching and calculations based on the method and rules.
Right. And finally, it generates the necessary tax reports, most importantly, Form 8949, detailing all your disposals, and often a summary similar to Schedule D. Some might even help categorize ordinary income for Schedule 1.
And these reports are ready for filing.
They're often generated in a format you can either directly import into popular tax filing software like TurboTax or TaxAct, or you can simply print them out and give them to your CPA or tax professional to incorporate into your return.
That sounds like a massive time saver and error reducer.
It really is for most people with significant activity. Of course, the other option is to simply hire a professional who specializes in this.
Like a crypto CPA.
Exactly. For individuals with particularly complex situations, maybe very high trading volume across dozens of platforms, deep involvement in obscure DeFi protocols, significant NFT flipping, or just anyone who wants the absolute peace of mind that comes with expert oversight, hiring a crypto tax specialist or a CPA experienced in digital assets is a great route.
What do they offer beyond the software?
They often use sophisticated software themselves, but they provide the human expertise to ensure everything is categorized correctly, help you choose the optimal accounting method, identify opportunities for tax loss harvesting you might miss, interpret really complex or novel transactions, and represent you if the IRS has questions.
Makes sense. Whether you use software or a pro, the starting point is still having all your data, right?
Absolutely. No tool or professional can help you without complete and accurate transaction data from all your crypto activities. Good record keeping, or at least ensuring you can download complete histories from your platforms, is the non-negotiable foundation.
Okay, this has been an incredibly detailed deep dive. Let's try to summarize some of the absolute key takeaways for everyone listening.
Sounds good. First and foremost, the IRS treats crypto as property, not currency. That's the bedrock.
And you absolutely must understand the difference between capital gains losses, which come from selling, trading, or spending your crypto property.
And ordinary income, which comes from receiving crypto through things like staking, mining, airdrops, interest, or getting paid for work, taxed differently.
Calculating those capital gains losses uses the basic formula, proceeds minus cost basis. But figuring out that cost basis is where the complexity lies.
Right, because you need an accounting method, FIFO, LIFO, or HIFO, or specific ID if you have perfect records, to determine which coins you sold if you bought multiple batches at different prices. Your choice here massively impacts the outcome.
And remember that big change. Starting January 1, 2025, the new per wallet, per account rule applies. Sales must be matched with acquisitions from the same wallet, requiring more granular tracking.
Critically, your holding period matters immensely. Hold an asset for more than 12 months before selling, and you potentially qualify for much lower long-term capital gains tax rates, 0%, 15%, or 20%.
Huge potential savings there. Also, don't ignore your losses. Capital losses are valuable. They offset capital gains dollar for dollar.
And if losses exceed gains, up to $3,000 per year can offset ordinary income, with the rest carrying forward indefinitely. Plus, crypto has that unique exemption from the wash sale rule, allowing immediate repurchase after selling at a loss.
You're legally required to report all taxable crypto activity, every gain, every loss, every bit of income, no matter how small, on the correct forms. Typically Form 8949, Schedule D, and maybe Schedule 1 or C.
And with Form 1099 DA reporting coming from exchanges starting in 2026, the IRS will have unprecedented visibility. Compliance isn't really optional.
Managing all this complexity really necessitates either incredibly meticulous personal record keeping or, more practically for most active users, utilizing crypto tax software or hiring a tax professional.
And lastly, don't forget that NFTs add even more layers of complexity. Potential income tax for creators, gains on crypto used to buy them, capital gains on selling them, and that looming possibility of being taxed at higher collectible rates.
The key lesson woven through all of this seems pretty clear. You just cannot ignore crypto taxes anymore. With the IRS ramping up scrutiny and new, more stringent reporting rules coming online, proactive understanding and accurate reporting are absolutely essential.
It's not just about compliance, though. It's also about strategy. Understanding these rules allows you to potentially make smarter decisions, choosing the right cost basis method, strategically harvesting losses, timing sales for long-term gains, all of which can make a significant difference to your financial outcome.
The power is really in being informed and prepared in this space, isn't it?
Absolutely. Knowledge is power, especially when navigating complex regulations like these.
Well, that was a truly deep dive into a very complex but critical topic. Makes you wonder, though. As digital assets, DeFi, NFTs continue to innovate and blur the lines between assets, income, and, well, everything else, how will tax regulations keep up?
That's the million-dollar question, isn't it? How will tax laws adapt to address the nuances of complex DeFi yield farming or wrapped tokens or NFTs that grant access or utility rather than just being art? Will that collectible classification for NFTs become clearer, or will we see even more granular distinctions based on function?
It feels like the only constant is change, right? The technology moves so fast, and the regulations are always playing catch-up. Staying informed about how these changes impact your finances feels like it's going to be an ongoing task.
It certainly is. It's a dynamic landscape, and continuous learning is definitely required for anyone involved in this space.
Absolutely. Well, thank you for joining us on this deep dive. We sincerely hope this comprehensive look at U.S. crypto taxes helps provide you with the clarity and hopefully the confidence you need to navigate it all.
Yeah, I hope it was helpful.
We'll see you on the next one.